7 companies are quietly controlling more of your money than you think. Here's the promise. By the end, you'll know exactly how and why it matters, whether you realize it or not. What is the S&P 500 actually? 500 of the biggest companies in America, bundled into one investment. Instead of betting on one company, your money spreads across hundreds. Historically, incredible. $100 invested in 1960 would be worth over $70,000 today. Dividends reinvested. Sounds great, right? You've heard this line before, though. Past performance doesn't guarantee future returns. That's not fine print. It's true. Nobody knows what happens next. Not experts, not analysts, nobody. And anyone on this app telling you otherwise is selling something. So let's talk about what we can actually measure. Risk, and where it's hiding right now. Your money isn't spread evenly across those 500 companies, not even close. A huge chunk sits in just 7. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. The Magnificent 7, each one worth over $1 trillion. When they win, the index wins bigger. When they stumble, you feel it too. And right now, all 7 are pouring billions into AI. Bad thing? Not automatically. But when this much money chases one trend at the same time, things get overheated. Fast. We've watched this exact movie before, by the way. The late 1990s, the dot-com bubble. Money poured into anything internet-related. Prices climbed way past reality, and honestly, the whole thing was obvious in hindsight, which is sort of the problem with bubbles. Nobody ever calls them in real time. Then it popped. Some companies survived, became giants. Most didn't. AI might genuinely change the world. Fine, nobody's really arguing that part. The stock prices today are a separate bet entirely, and mixing those two up is how a lot of smart people lose money. Quick gut check. Does concentration risk matter to you personally? Yes, actually, even if you've never picked a stock in your life, because your retirement fund is probably sitting inside this exact setup, right now. There's a second blind spot, too. Geography. No country stays on top of global markets forever. History's blunt about that. Put a number on it. In 1900, Britain controlled roughly a quarter of the entire world's stock market value. Today, a tiny fraction of that. Japan's version of this is even sharper. In 1980, Japan made up about 15% of global market value. 9 years later, in 1989, that number hit 42%. Everyone thought Japan was unstoppable. Then it wasn't. Nobody saw either shift coming while it was happening. That's kind of the whole point. Companies like Samsung, Toyota, Nestle, massive, successful, completely missing from the S&P 500. Not because they're bad businesses, just geography, wrong headquarters. An index built around one country misses everything outside it. Simple as that. Here's a pattern worth knowing. How people react when prices crash. Stock drops 20%, 30% fast, panic kicks in. People sell to stop the bleeding. Except, quick math, if your $10,000 drops to $7,000, you haven't actually lost anything. Not yet. That loss only becomes real the second you hit sell. Some of history's biggest recoveries happened right after the scariest drops. Selling in a panic is exactly what erases your shot at catching that bounce back. To be fair, none of this means AI is a bubble. It might not be. None of this means concentration is dangerous either. It might work out completely fine. Nobody actually knows, and anyone claiming certainty either way is just guessing out loud. What history does show is the pattern itself repeats. Concentration builds, hype outruns fundamentals, and eventually it corrects. Sometimes gently, sometimes not. That's really the illusion here. 500 companies feels safe, feels diversified. But feeling diversified and being diversified aren't the same thing. You can technically own 500 names and still be riding on the fortunes of 7. Is this time different? That's the question actually worth sitting with. If this changed how you look at your own portfolio, hit subscribe. This channel breaks down how markets actually work. No fluff, no advice, just the patterns. Drop a comment. Which part of this surprised you most?